This is the 10-Minute Contrarian Podcast. This is VP. We're a solutions-based podcast, diving into the world of contrarian investing and alternative finance. You can find us hosted on the No Nonsense Forex YouTube channel, NoNonsenseForex.com, and podcast players everywhere. Episode 211 is brought to us by Bybit. If there was ever a platform that just gives you everything, the best of everything, and then gives you tons of rewards simply for trading on it, it's going to be Bybit. Trade metals, crypto, Forex, stocks, anything you want now, and rewards and giveaways just come out of nowhere. And might I remind you, one of our very own contrarians won 2 whole Bitcoin in a raffle that cost nothing to sign up for. It's like, here's $200 and something thousand. Congratulations. But this does not happen if you're not actively taking part. Go down to the show notes, click the link to the Bybit blog. Read the blog if you like it. Go down to the bottom and click my affiliate link and get started. And by started, I mean deposited and actively trading, because with Bybit membership has its rewards. It is the 10-Minute Contrarian Podcast, and I am more excited than usual to bring this episode to you. And I'm always excited to bring these episodes to you, but especially this week, because for a couple reasons, really. One, we have not talked about ETFs in a while. We used to do it all the time back in the earlier days of the podcast. I don't know why we stopped. ETFs didn't stop becoming awesome. If anything, they've gotten more awesome. But in particular, I like bringing these more grown-up episodes to you because I know my numbers are going to suffer. But the good thing is I really don't care about my numbers. If there's something I want to talk about, I'm going to bring it to you. I just always find it interesting to watch my numbers go up and down depending on what I'm talking about. So which episodes do the best, VP, numbers-wise? Macro doomer episodes. You guys eat that shit up. I now understand why certain podcasts out there do as well as they do. But we are, unfortunately, a solutions-based podcast. And episodes like this are so important because it's really hard to talk to people about downside right now because the upside is just so good in so many things we invest in. People just want more and more of it. But we have to understand, we always forget this. You need to have positions in your portfolio which really, really mitigate your downside. Don't forget, when you're dealing with asymmetry like we do here, even your more conservative plays are going to go up a lot. The difference is, if you just like my YouTube channel with Forex trading, if you just find a way to not lose your ass all the time, you're going to do really well because the upside is so great. It's simple mathematics. I know we have people who listen to this podcast that just simply chase the most upside they possibly can. And if you're one of those people, just know, percentage-wise, my portfolio is always going to outperform yours. Why? Because the math is in my favor, and I want to put it in your favor. But sadly enough, people just don't do this. You need your more broad-scale ETFs, which don't go up as much, but also don't go down as much to serve as anchors to your entire portfolio. If you don't have an anchor on your boat can end up drifting just about anywhere. These types of ETFs serve so many different purposes. First off, it can give you exposure to sectors you're underweight in. And then once you have coverage there, you can just kind of leave it alone and go on to other things if you want to. We'll talk about that in a moment. But when done right, and when you get in these things when they're cheap on top of that, now cheap can mean a couple things. They can either mean they're bottoming, or it can mean they're just relatively cheap to what's going on right now. And you just have the wherewithal to stay in them. Good things can happen. I mean, nobody's going to get excited about GDX, which is an ETF that I hold. You guys know that. But my GDX position is up like 95%. Or it was last I looked this week. That's tremendous. Like most investors would dream of returns like that, even though it took a few years to get there. Now, did GDXJ do better? Yeah, it has performed better, but it doesn't matter. GDX made a lot more sense for my overall strategy. I'm really glad I have it, and I'm really excited in the future prospects of it. And it gives me full coverage across all of the major gold miners. So I can not only have exposure to them, I can focus on more mid-tier gold miners when it comes to my individual positions. I'm telling you, these things are just the best of everything. And I will bet the majority of you are very underweight on these, if you have any of them at all. And GDX really is not even a great example because that only covers gold miners and silver to a degree. A lot of those gold miners do produce a lot of silver. But you can do what we love to do here. We take things which are inevitable, unavoidable. They have to go up at some point. Buy one of these ETFs so you have full coverage across the board. So whichever one goes up, you are going to benefit from, no more guessing. And then a lot of times the other things that you had in that ETF are eventually going to catch up. Because I've said it before, and many times on this show, there's nothing worse than being right when the rest of the whole entire world is wrong and still fucking it up. Ask me how I know. I've done it a couple times. And there is no worse feeling. This way you get to be right and profit off of it. And if you want to speculate on more individual sectors, then that's fine. You now have the latitude to do that. But you have to start here. Now, I've had 2 of these in the past, and I sold them to get liquid for other positions. I'm going to be getting back into them. I want to be fully prepared for the next 5 years. And I don't have an endless money fountain to where I can just invest in every single sector and every single stock I like. But with these, I don't have to. So what's great now is with AI, you can tell AI exactly what you're looking for in an ETF, and it will get you as close as it possibly can. Before, I would always try to make sure I included stocks on the LSE and the ASX, just to make sure I had most of my audience covered. I don't even have to do that anymore. You can just go to AI and say, hey, I heard about this ETF. Can you tell me the equivalent or what the closest ETF would be here on the Aussie Stock Exchange or on the Canadian Stock Exchange or on the Hong Kong Stock Exchange? Whatever you have access to. You can also tell it, I want exposure here, but I don't want exposure here. Give me some of this, but eliminate some of this. They will get it as close as possible. It's really great. But what I'm about to do here is to give you some really compelling options on the American Stock Exchange. And then, as always, let you take the information you hear and go take it from there. Remember, I am not an advisory service. I simply point you in a direction and then let you go and run with it any direction you'd like. So as always, this is not financial advice, but let's talk about some very compelling ETFs out there in the space that give you broad coverage in certain sectors. Let's see, where should I start? I got some good ones here. Okay, so if you feel like you're a little bit underweight gold and silver, or you would simply like to have more and then just kind of close your eyes and forget about it, there is the Invesco DB Precious Metals Fund, ticker symbol DBP. And this one is quite interesting. It is going to give you coverage to the gold and silver markets via the use of futures contracts, which is very common in ETF land. So you're not going to get physical backed here, but the trade-off for this is what you will get is a dividend. As you probably know, dividends are not very common in gold and silver world, but you will get one here, and it is currently going off at 3.5%. So if you're going to sit and squat on these things anyway, get paid and let that dividend compound. You guys know how magical that can be. If you don't, or if you're new, please go back and watch the dividend material that I've made on this podcast. It is quite the cheat code. To be able to invest the way we want to invest and also get paid for it is, I don't even have a word for it. It's awesome. Now, if you would rather have the safety of having physical backing to it, consider this one. It's going to be the Aberdeen Physical Precious Metals Fund, ticker symbol GLTR. Glitter. Get it? Now, this one is going to give you coverage, but to all 4 of the precious metals out there. So gold, silver, platinum, and palladium. Platinum and palladium, if you haven't been paying attention, are starting to really move. Now, of course, no dividend here, but if you just want coverage to everything, and just kind of be done with it and be able to move on your way, whether it is staying in the precious metals space and going further up the risk curve, or maybe you're just more interested in things like energy and crypto, but don't want to get left behind on the precious metal space, something like this is perfect. Now, while we're here, I'll go ahead and give Aussies a layup here. There is a version of this on the ASX, ticker symbol ETP MPM. So check that one out. Whether you like investing in metals mining stocks, but you don't have a lot of, kind of like we talked about with the football team, you don't really have a goalie or a lot of backs, this really kind of takes care of that in one fell swoop. And then again, if you hate it every time VP talks about metals on his podcast because you're just not interested in it at all, but you also know that VP is onto something with them and they probably will go up a lot, well, here you go. Set it, forget it, move on to the things you like more. There is an absolute place for broad scale ETFs in your portfolio, no matter who you are. Again, that's why I love episodes like this. If you invest in asymmetrical markets, but you play it right and smart, like a grown-up, the sky is the limit. And that is exactly what we try to do here on the 10-Minute Contrarian podcast. But let's keep going here. I'm really a big fan of what Invesco's been doing. I have a couple more for you here. This one is sticking with the DB family, the Invesco DB Base Metals Fund, ticker symbol DBB. Now, we don't talk about base metals a whole lot here on the show, and the reason is there's a time and a place for them, and we just haven't reached that time or place. I've barely ever talked about them, and there's a reason for that. And if you go look at charts, you will see the reason why. I kind of nailed this one simply by not talking about it. But base metals are very broad, and depending on where you go with them, good things can happen. Now, what DBB gives you is coverage across copper, aluminum, and zinc. Now, I would be willing to bet that the majority of my listeners are very underweight copper and should not be, and you probably wish you had more exposure. With this, you also get aluminum and zinc. Zinc, I'm not super excited about, but aluminum, I kind of am, and you're going to find out why in a couple episodes, maybe next week. I'm not sure how I'm going to schedule this. But let's just say you are going to want a bit of each of these things. And I will admit, finding good quality stocks in the copper space and the aluminum space is much more difficult than gold, silver, uranium, oil. I mean, it is. So if you just want to get some coverage here right away, this is a great way to go too. Let's go ahead and move on to energy, though. And the big, beautiful bill in the United States just passed. Now, I said before, America is going to need to reindustrialize because we're going to need as much energy as humanly possible to do the things we are trying to accomplish and keep up with the Chinese. This administration is very aware of that, and this administration is making moves towards that, and the big, beautiful bill passing, whether you like it or not, was a big step in that direction. Now, you cannot reindustrialize without copious amounts of energy, and the U.S. has that domestically. And it just so happens prices of oil and natural gas have been depressed over the last few years, so this is a good time to take advantage of a sector the U.S. is going to have to rely on heavily going forward. Back to Invesco. This is the Invesco DWA Energy Momentum ETF, ticker symbol PXI. A lot of you don't like messing around in the oil and natural gas space, and I like it, but I can't blame you for not liking it. But if you pretty much know we're going to need it, and you're looking for something that holds its value pretty well when stocks go down, look no further than 2022. This sucker went up a lot when everything else was dropping. Then this could really be something for you. And contrarians, if you want to go put this sucker in your monthly chart, you may notice that it might not be giving you a signal just yet, but it could be getting close, so this absolutely should be on your watch list. This thing just serves so many purposes. We all know oil and gas is a very frustrating sector to invest in. So if you just want to say, hey, just give me something like PXI and let me be done with it, I mean, you could do a lot worse. I'll tell you that. This really could be kind of the low-key gem of this entire episode. Who knows? But I got more for you. We're not just stopping here. If you made it this far into the show, you're in for a treat because the ETFs I'm about to talk about are also similar to PXI, coming off of intermediate or long-term lows and are probably starting to look really tasty on the monthly chart. So the people who did not stay to the end of the show are going to miss out, and I hope they do. These are just for us. I want you to check out the iShares MSCI Global Metals and Mining Producers ETF, ticker symbol PICK. PIC. Those of you who have been with me for a while, do you remember the Big Miners episode we did? That was a cornerstone episode of the 10-Minute Contrarian podcast. If you have not listened to it, or if you've forgotten about it, go back and listen to it. Because holy shit, I want big miners in my portfolio, and I will have big miners in my portfolio for a very long time. I'm just waiting to time it right. And if you've been following the big miners, you know that that time might be arriving. Now, these things have been depressed to where they have gone down. They shouldn't go down this much, but they have gone down a lot, progressively. And they are in such a sweet spot right now. It's just a matter of time before I pop on one or two of them, at least. Man, to be able to get these things at a low price and then just sit on them forever as they continue to be the major players in mining metals that the entire world is going to desperately need, come on. And these things always pay good dividends. So now you're going to give me wages on top of that. You're going to give me a salary on top of that. Okay. I get so excited when I watch the price of these things just drop and drop and drop for no good reason. These things should not be this cheap. And with ticker symbol PICK, you are getting exposure to all of them. You know, again, you don't have to sit there and allocate your capital to one or two and hope you pick the winners. Because I think they're all going to win, but some are certainly going to win more. But with this particular ETF, you can just put some money aside and, again, be done with it. I'm very happy something like this exists. Now, there is one trade-off here. Now, you will get full exposure to all 5 of the big miners, but it will come at a smaller dividend. PIC is currently giving you just over a 3% dividend, and that's going to go down to under 2 once you factor in the expense ratio, to where the individual big miners right now are giving you a lot more. Now, here's what I will say to that. As the price of these stocks go up, the dividend almost always goes down, or the dividend yield almost always goes down. And this is just very simple mathematics. If you guys were unaware of this, I want you to be aware of it now. Companies don't offer dividends by yield. They offer dividends in dollars per share. And so when that share price, that denominator goes up, then your yield percentage obviously goes down. So you're seeing some crazy dividend yields right now on some of these big miners, but that's because the price is down. Those dividend yields will drop as the price goes up. So you just have to decide. Do you want to pick your favorite one or two and squat on them? Or would you just rather have an ETF like this that gives you all of them at a lower dividend? It's totally up to you. Options are great to have, and just be grateful that we have them. And oh, by the way, put this on your monthly chart and let me know what you see. You might be getting close, or you might already be kind of there with this one. I don't know. And I know there's people out there who might be saying, well, I'm actually not that close. Maybe my algorithm's off. No, it's not. Your algorithm's fine. But I know for some of you, this one is going to be getting close to a signal. Now, if you love the idea of things we're going to really, really need and are probably coming off of long-term lows as well, and I don't know why you wouldn't love that. That's like the absolute best case scenario you can ever come up with in our world. As much as you might want to because you're being emotional about it, do not sleep on green energy going forward. Just because a bunch of assholes made stupid rules about green energy years ago doesn't mean it's not really great. And it doesn't mean we're not going to absolutely need it. We're going to need energy no matter where it comes from, and lots of it. Like, what did we do back in the day? Like, burn animal dung. If there's an animal dung company or ETF, I'm looking at it. Like, we're going to need every single molecule we possibly can. And the good news about the climate change scam being identified and being proven to not work very well in its current form is that the price of these ETFs have gone down a lot. Again, sweet divergence. Not green energy's fault. It's just that version 1.0 was kind of a failure because the people behind it didn't know a lot about energy. But now there are more adults in the room. And again, we are really, really going to need version 2.0 in a bad way. I just think as energy investors, it is irresponsible at this point to ignore this space. Not for environmental reasons, even though I love the environment, just for pure utility. I mean, China gets this. China is going all in on green energy, not because they want to clean up their environment. They've never wanted that. I mean, they kind of do, but they're going to need to compete at every level because, like I said, there's only X amount of molecules out there. And certain countries are going to get them, which means certain countries are not. And this is going to equal absolute power in the coming years. No pun intended. But he who has the energy is going to have the leverage. Anyway, so there are two ETFs I really like in this space. The first one you may have heard of. It's a big one. It is the iShares Global Clean Energy ETF, ticker symbol ICLN. And I'll just go ahead and give you the other one I like. I need to read it off because it's long. The First Trust NASDAQ Clean Edge Green Energy Index Fund, ticker symbol QCLN. And these are very easy because they just really track indices. The first one, it tracks the S&P Clean Energy Index, and the other one follows the NASDAQ Clean Energy Index. Pretty simple. Again, make sure you look under the hood and see what they actually hold. But you will notice that both of these are coming off of long-term bottoms, which we love here. And you just need to plug these into your charts to see what it looks like. But again, coming off of a long-term bottom that just kind of sat there for a while and now it's finally waking up, this is exactly the scenario we look for here. And these are both doing that. And I mean, I'll say it right now, green energy is such a pain in the ass sector to research and deal with. It would be so great just to have coverage here and then never have to worry about it again. And remember too, if you don't have access to the United States stock market, you can just go to AI and say, hey, give me the British equivalent of ICLN, and something will pop up. And if you want to help the community, I know most of you are on audio. This podcast does go to YouTube. Now, it's funny when I say this. Either people really come through in a big way or they don't come through at all. If you have other broad-scale, 10-minute contrarian style ETFs that you like or that you have found and you find to be compelling, go to YouTube and put them down in the comments section for all to see. And the one thing I would ask is don't just put the ticker symbol, kind of explain what it is and why you like it. It takes all of 20 seconds to do. But I'm going to say it again, if you don't have ETFs like this acting as anchors and cornerstones to your entire portfolio, I just don't think you're doing things optimally, especially if they're coming off of lows. I mean, the best thing about that is if they fall, they can only fall so far. They're not going to zero. Precious metals aren't going away. Energy is certainly not going away. To have fairly limited downside and tons of upside, I mean, this is what we play for. This is why we're here. And other, usually younger investors who are in this asymmetrical space aren't going to want to do this, and they're going to look at you like you're some kind of boomer for putting your money here, which is bananas, because these are the best of everything. Because with these, you get to be a little less crazy and still be super early.